Hi everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through precious metals ratios, look at kind of what's going on over there. I do think precious metals are aligned quite well for a run potentially in the near term. And I'm going to go over kind of the conditions that precious metals do well in to show you guys um, basically the setup. So what I look for in all this stuff is I look for a basically an alignment of all these different things in terms of market conditions. The market conditions are aligned by the real estate cycle. Then you look at the ratios. You want that to be in alignment. You want that to be moving positive for your investments. And then you want to look at the subsectors that you're interested in and see that they're cheap to all the other sectors. What that does is it gives you the largest risk reward opportunity for investing. It says that this thing is bombed out because we have hit the bottom of that cycle and that cycle could be turning and coming back up. And that's where you make outsized returns. What are outsized returns? I'm talking multiple hundreds of percents or even thousands of percents, depending on how out of balance the market gets. The way that you make that type of money is it generally lasts anywhere between a couple of years to a decade, depending on asset that you're in and if you're going to ride across the business cycle or other smaller cyclical cycles in the big secular trend. Um, and right now we've got, I think, a decent alignment, a decent alignment. So I'll talk about the overall alignment here and look at some of the ratios. Let's dive in, see what's going on, and I'll give you my financial opinion. Again, if you need any help, if you want to figure out what individual companies to play this with, then check out the finding-value.com, join the community. That's where I talk individual companies, ETFs, leverage ways to play it, or non-leverage ways. It just depends what you want. Let's dive in. Let's take a look. I've got the TYX TNX ratio up there. What is that? That's a ratio of the 30-year yield and the 10-year yield. Now, gold generally does well when the yield curve uninverts. So when you go from a low point to a high point, low point to a high point, and a low point to a high point. Now, are we early? We could be. We could be a little bit early. That's okay though. We don't have to be nuts on picking off the bottom. And it's okay to be a teeny bit early. And why do I say that? Because if you're a long-term investor, if you can get the bottom within like a couple of years, and I know that sounds like a lot of time, your upside return when it turns is so big, it just doesn't matter. These guys that wait and they try to time things, they try to trade in and out of the market. They're trying to make, 20, 30, 40, 50% returns. And that's fine. They'll be like, well, you're losing. It's an opportunity risk. It's like, guys, it's not an opportunity risk when you get a 20 bagger or a 10 bagger. That is not a missed opportunity. And even if that takes you 4 or 5 years to get that, that's okay. That's plenty worth the wait. I'll just say that. So that's what I'm trying to aim at. Yes, I am trying to buy a bottom of bottoms. I am trying to do that, and it usually takes a little bit longer trying to buy the bottom of the bottom. So we are at a very cheap ratio for this rate for this ratio, the 30-year yield divided by the 10-year yield. When that uninverts, when the 10-year goes down faster than the 30-year, this will go up. I see a strong correlation between this going up and the price of gold moving higher. And we're at a pretty good spot that we are pretty low. So what does that mean? How do I know that it can go up? What are the correlations? Well, this ratio, and we'll look at a different ratio here real quick. We'll do the 2 and 10-year ratio. This is the 2 and 10s here. And gold, again, gold does very well when you go from a low point to a high point. These go up. That's generally where they do very well. Gold does very well in that type of scenario for the most part. or no, sorry, when they go down. Sorry, when it goes down. I'm looking at this opposite direction. So a good time to usually buy it is in these sections here. That's a good time to buy it. We're at a very elevated level. We are coming back down. So if you had purchased it in this general area, you would have bought in here, in that general area. If you had bought, would have bought in this general area through here. And then in this area, you would have bought in here. And in this area, you would have bought, could have bought over here. But right here where we're at is another good spot. And that's kind of using this as an indicator of where to buy. We're using 2 and 10 or TYX, TNX, which is on the longer end, which the Fed doesn't control as much. And generally speaking, when this goes down, that is when gold goes up. When it goes down, it usually goes up. And you can see that in almost every one of these cases. And then when you get to the low end, well, that's generally when you want to look at other investments. It could be oil, it could be some other inflation sensitive asset or technology stocks or something like that, depending on what it is. So I think we're at a pretty good spot where gold, silver, platinum could do quite well, and I think the market conditions are aligning for that to occur. So we can look at the pricing of gold and see that we've pulled back and that we've got a nice little bullish candlestick. We also have war going on, basically in Israel, and that is also generally pretty inflationary, where it drives oil prices and gold prices to the upside. Silver also throwing in, it came back, throwing in a pretty big candlestick. But again, we have not broken the big downtrend line yet. We're still below it. We're still very early. And I think that this could change quite rapidly depending on how that yield curve behaves, depending on if we see yields drop. And if you look at the dollar and you kind of zoom in here, this looks like it's ready to drop. We've squeezed up to the top. It looks like it's ready to go lower. Got the 2-year yield. That's also squeezing up. That looks like it could potentially drop. So what we're doing is we're looking at all of this data that is kind of coming into alignment where I think precious metals could outperform. And that's why we are looking at this area for potential investment. We also can look at the XAU to gold ratio. I've got it right here. The XAU to gold ratio is also at just an extreme blown out ratio down here. But again, have not broken out of the downtrend line. That downtrend line is need to break this line for happiness for gold and silver mining companies. Haven't broken it yet. Does that mean that we should, not buy it down here? Some people would say yes, but those that can take a really long-term approach, you could be aggressive, maybe accumulate if some of the individual companies look good to accumulate, if their chart patterns look good, which some of them do. So I'm going to scroll down and start looking at some of the ratios to give you guys an idea of what those look like. We've got platinum to gold. Platinum gold ratio, this is your Batman top in the ratio. There's your Batman. Hey, Mr. Batman. That's going to go down. Looks like his eyes are a little close together, but that's the Batman top. This is a ratio what I would consider to be fully valued or slightly expensive for platinum, which is over 2. If you had swapped your platinum to gold at about 2, let's say, which is down here, which is a very doable level, that line there, and you swap it where we are today, you would have made 4 times your purchasing power in real terms against these two metals. And remember, these two metals go up over time as their cost curves go up. So you could have taken your platinum, swapped it to gold. You would have 1 ounce for every every 1 ounce of platinum, you got 2 ounces of gold. So you swap your 1 ounce of platinum, get 2 ounces of gold. We wrote it all the way down, and now we're taking the 2 ounces and taking 2 ounces of gold and going to swap it for 4 ounces of platinum. We went from 1 ounce of platinum all the way down to 4 ounces of platinum. So that is in this time frame of '08 till today, you would have increased your purchasing power by 4x. Now that is not 4 times currency supply. No, that's not 4 times price. That is 4 times real wealth. Platinum up here, yeah, I don't know what the price is here, but when we ride this back up, we go back up, you are going to get a massive revaluation of your platinum ounces because platinum is going to be expensive up here. And I'll just make a guess. Let's say it's $4,000 up here, or 5,000, or 6,000, or something like that. Well, now you've got 4 times your true wealth times whatever the currency is when it goes up. So we've got a massive opportunity here to increase our purchasing power gains with platinum. Platinum is incredibly cheap. We're up against support. And I think down in this region, very good. Platinum versus palladium. It is starting to outperform. Now, I used to own palladium. I bought palladium in 2005. I bought it in 2009 at the peaks. And I had ridden it all the way down. Now, someone would say, that's a really long time. And you know what? It is a long time. I was a young guy back here buying this, and I had just by luck bought some of this because it was so cheap. And I was like, it'd be cool to own some palladium. And I bought a good chunk of it, right? I thought it was cheap. And I didn't know anything about ratios back then. And then I realized ratios kind of in this era, somewhere in that era there, mid 2010s, and I started buying the crap out of silver. I mean, I bought the crap out of it in other areas. I made my swap in April, right here, where I swapped all my palladium to platinum. The ratio was a little bit below zero point 0.4. And you can see I've doubled my wealth in terms of ounces of palladium. I know I'm owning platinum today, but platinum's outperformed palladium by 2x since my swap point coming up. And why did I swap it in April? Well, I was going to swap palladium for either silver or platinum. I was struggling to find silver for a cheap price. The premiums were way up there. So I decided to do platinum because I got a really good deal on platinum. Nobody was buying platinum, and I got a really good low premium on it. So that's why I swapped to platinum. I did it because people were very fearful. We saw a gigantic market crash in the market. So I figured, well, with the premiums so low, now would be a really good time to swap the metals. And with the ratio so low, I didn't think it would go down much further. And it didn't. It just stayed there for a while. I went sideways for a while. So you had a pretty good time to really swap out of the metals. But I did it because the premium was low, the metals were available, easy to do. And I think that platinum was going to do a large outperformance, hopefully, of palladium and get back to those levels of maybe above 4. It went all the way to about it went to 6 at one point. Man, if you could swap your metals at 4.5 or 5, that would be very big outperformance. That would be going from 0.35 all the way back up to potentially 5. That is over a 10 times increase in true wealth if that were to occur again. And I think it will at some point, but you're going to have to be patient. Platinum versus silver. As weird as this sounds, guys, this looks good for platinum to outperform silver at some point. It still looks good. Now, does this mean that it has to outperform? No, it doesn't have to, but it could potentially outperform. And I think platinum is at a very cheap price in relationship to silver. So what does this mean? Platinum's been cheap to gold, platinum's been cheap to silver, platinum's been cheap to palladium. Generally, what I do is I just buy the metal, load up, just ride it on up. That's what I'm gonna do, and it's gonna probably take a couple years at minimum, all the way up to a decade at maximum. And the last time we had this type of alignment where another metal was this cheap was palladium back in 2009 and rhodium back in 2016. Rhodium 2016, palladium in 2009, silver was cheap in 2000. And you get these periods where you can buy these metals where they're just blown out cheap against all the other metals. Gold versus silver. Is this a false breakout? I don't know yet. No one does. And we came up to the top here. Let's see if this breaks back down. I think it's a possibility. So if we break back up, that means that we're in some sort of economic problem, which we could be. And we're gonna see this move on up. If this is a false breakdown and it rips to the downside, then we know that we could potentially have an outperformance of silver. Why do I think that could be the case? Because copper is also moving to the upside dramatically. Copper also, I don't want to shift all the way up, but copper bounced pretty violently Friday. That could be a false breakout to the downside. So copper and silver do have a correlation a little bit based off of economic activity and growth. So coming on down, we can look at palladium versus silver. Again, I think silver is the one to own here instead of palladium. You can see these very big blow off top moves for the valuation in palladium versus silver. The bottoms are a little bit different down here. These are your bottoms back here, where silver outperforms on the way down, palladium outperforms on the way up. These are your pads that you want to swap your silver into palladium. So this is palladium, and then you want to sell your palladium up these tops here. And be so, if you can do that and you get large valuations. So I think we're going to come back down where silver could outperform palladium for a period of time. Dow Jones versus gold. This is an interesting looking chart. I kind of drew trend lines through here. It looks like it's squeezing up. Is there a possibility that we break to the upside, have a blow off top in the Dow Jones from money printing, perhaps? It's possible. It is possible where the Dow Jones gets another big blow off, move to the upside. If it were to break to the upside, it's definitely possible. But generally speaking, in inflationary periods, they generally break to the downside. So again, we'll see what happens here. And we are in that inflationary period. Gold versus Dow Jones, if you were to swap those two, you can see that we're basically putting in a double bottom, swapping those two assets. There's your bottom and there's your bottom that we are squeezing up, and we could get a potential break here. We have not broken yet, as weird as that is. And this is the squeeze that I'm seeing here. There's the squeeze. Now, could this go and break down to the downside for a period of time? Possible. It's possible that we do a move lower, break down, and then basically a slingshot to the upside. It's very possible. How could that happen? They print a bunch of money, everybody runs into stocks, and then it rips to the upside as people realize that those stocks aren't going to make anything because the input costs are going to rocket to the upside. So it's possible that there's like a slingshot maneuver here where we go downward and then we rip it to the upside where gold just outperforms almost everything. Gold versus crude oil. We're still at what I consider to be a very cheap price for crude oil. But if the right market conditions come, it is possible for gold to outperform crude oil if there is a slowdown in the market. Then we've got, crude oil and all these other ones there. We've got gold versus TLT. We can see a massive outperformance of gold versus TLT coming on up like this. Look at the outperformance here. These are people basically preferring to hold gold over bonds. I think that this could accelerate to the upside at some point. Doesn't mean it will be a straight line like we've got. We could get a pullback here or consolidation for a little bit and then a continued upward move. But the way that I look at it, guys, I think holding hard assets is thought to be in an inflationary area or in an era where we could have a bond problem, bond crisis. Looking at other stuff for gold. We also have gold to M2 money supply. This thing looks absolutely great for gold. It does look like that double bottom that we're getting. and it's at the bottom of the double bottom. So what this means is that when the right market conditions come, I think it's going to go all the way back up here under probably a slowdown in the market or stagflation or whatever it tends to be. And we got a nice little up move there just recently. But we've broken the downtrend against the M2 money supply, and we're getting our breakout and a return move, and we usually launch from that return move. So that looks good. This is gold versus total bank credit. And you can just see we're putting in these big double bottoms here, and all the charts look the same. So Dow Jones is the same as total bank credit, which is the same as M2 money supply. It's all interconnected, all financialized trading. So that's what we're seeing in a lot of these. And I do think I mean, there's other metrics that we can look at, like producer price index, and what that looks like, and how that's outperforming the S&P 500. It's all data for basically gold and precious metals to outperform. We're just waiting for the right market conditions for that money to rotate. What generally happens too, another indicator is you can look at unemployment, and when unemployment generally goes up, that's the time that gold starts to drop. And that is, if we were to look at unemployment, we could do that real quick here. Here's unemployment. Here's the unemployed level. And if we were to kind of overlay gold with it, there's a soft correlation here. So if you kind of buy when it's down here, that is generally a good time. And when gold is cheap against other assets, you want that alignment. Here's another area down here. You buy it down here. Down here would be another good area to buy, and basically right where we're at today. So generally, that's another indication of where we are in the business cycle, and unemployment goes up during a slowdown. Now, are we at that exact point? Are we gonna stay low in unemployment? No one knows that guy. I think we're gonna stay low for a little bit, but we could come up, and that's gonna be a tailwind behind metals. So I think precious metals looks pretty good. There's a good opportunity there. And I think if you're looking for a way to not really play it with too much leverage, buying the physical metals, that's the lowest risk, most upside reward that the market has to offer today, period, of anything. Reason is because the upside is decent big and the risk is so low that I think this is kind of a gimme for someone to consider for their. All right, guys, that's what I've got for today. Thumb up for the content, subscribe to the channel, and we'll catch you guys next time. Finding value.